Hello and welcome to Risk Watch Plus. I'm TD Wilcox.
I'm Ken Agel.
And today we're going to go over a few interesting topics in the risk and compliance world. Each week we monitor dozens of websites and bring in the most interesting of content. You can sign up at our website and it is free, and we are able to give you all that information in a nice condensed format. Today on Risk Watch, we're going to be covering a few of the hottest topics as identified by our Risk Inbox editors. Let's take a look at the first one.
Yeah, this is the topic that we covered last week in our compliance spotlight, the Community Reinvestment Act, or CRA.
So if we look on May 20th, the OCC unilaterally released a revised Community Reinvestment Act rule.
That's right. But then on July 11th, the House Financial Services Committee, Maxine Waters, and Chair on the Subcommittee on Consumer Protection and Financial Institutions, Gregory Meeks, basically said that this particular effort was not what they were looking for at that time. And they said that it would be harmful to the Community Reinvestment Rule finalized by the OCC. This is what they said.
It is completely unacceptable for the OCC to use the cover of a pandemic to rush out a rule that will be harmful to communities that are already suffering during the crisis.
Yeah, I think we know that anytime you're talking about a proposed change to an important law, you want to make sure that you've gone through that process. So what the House is saying is it's probably not the best time at this moment.
What are the odds of that this resolution will become law?
We know that both chambers of Congress as well as the president have to sign this for it to become law. It doesn't have a lot of chance. Now, TD, that doesn't mean it doesn't have impact on us right now, because anytime there is a proposed change, whether it becomes law or not, it still has ramifications on the community, especially on the examination community. So I think you're going to see a little bit more, especially given our next topic.
So over here, let's talk about the redlining and its impact 40 years later.
Wow. So this topic, of course, redlining has been around for a long time. It is the practice of identifying by geography areas that would be avoided by lenders, as opposed to greenlining, which is efforts that would be encouraged by lenders. This practice has been illegal, especially on the basis of race and other protected factors under ECOA, the Fair Housing Act, and other regulations. So what Redfin did is they started to identify what has been the impact as it relates to value. Because when we really talk about neighborhoods, we're really focusing on, well, how is this impacting us? And their analysis shows that areas that were redlined have had $212,000 less in property value increases than neighborhoods that were greenlined. So basically, when you take a look at that type of factor and combine it with the fact that black homeowners are nearly 5 times more likely to own a home in a formerly redlined neighborhood, we're talking about significant impact.
Which kind of is a great segue into our compliance spotlight of the day. And that's going to be talking about a high-level lending analysis in the Minneapolis area for mortgage.
Yeah, Minneapolis, of course, has been in the news as of late, and so it seems like an area that's going to receive a lot of scrutiny. Of course, in our world, we tend to deal with stuff that has happened in the past, and so we're going to take a look at what we call the Fair Lending Institutional Performance Studies, or FLIPS. And I think it makes sense for us to take a look at the Minneapolis area, so let's focus on that. Now, 2018 included 15 million entries, not all, of course, in Minneapolis, but nationwide. And that was among the 5,700 or so institutional lenders or reporters. That included, of course, banks, credit unions, but also mortgage companies. Now, when we take a look at Minneapolis, I think it's important to understand a little bit about that community as it relates to the MSA. Of course, the MSA officially is known as Minneapolis, St. Paul, Bloomington. That particular area, there were 195,000 or so entries by the 738 reporters. Now, we want to focus on probably the most significant 2 areas, approvals and denials. It's important to isolate 2 products that have the most significant impact. And so we want to take a look at conventional first lien loans. Before we do that, I want to talk a little bit about information on Minneapolis, St. Paul, Bloomington, MSA. Now you could see in this slide that there is a population of roughly 3.6 million. It also covers a rather large geographic area, 7,600 square miles, with a density of 475 individuals per square mile. So it's a fairly dense area, relatively speaking. Of course, when you take a look at the population, as it relates to the demographics, you can see that it is relatively homogeneous, with 18 to 64-year-olds comprising 62% of the population. Now take a look at the race ethnicity. As you might expect, it is evenly split on female to male, but when we take a look at the percentage by race ethnicity, we could see that 75% of the population is identified as white, 9% as black, Asians comprise 7%, and Hispanic 6%, with other groups comprising combinations of those demographics. Now the next slide, I think, is far more telling as it relates to the future, and so let's take a look at that. This is the labor force data as recently released, and it shows the changes as it relates to unemployment, employment rates. And you can see that the unemployment within this MSA skyrocketed. And when I say skyrocketed, can you see that percentage change over 1 month?
Yeah, it looks like it tripled.
Tripled in a month. I don't think in my lifetime, I'm sure in my lifetime, that's never happened. So that's pretty important, because we know when economic impacting events such as COVID, such as what's happening as it relates to the world associated with events like George Floyd, we know that we're going to see an immediate response requirement, which is kind of why this is going to be an important topic. So let's take a look at the lending as we understand it. For the first lien loans, conventional first lien loans, we're going to call them CFLs. We can see that we had approximately 72,000 approvals and approximately 11,000 declines. That's about an 87 to 13% change. We also know that there were 630 unique lenders, those LEIs, that's the reporting indicator for those entities. Now the top 20 by volume accounted for over half of the entries. So what we're looking at is a lot of concentration among those top 10. Now in the pie chart that you see, we're looking at the top 10 insured institutions. So within the top 10, we had a lot of the major mortgage companies, such as Quicken and others. But we're not going to focus on the top 10 lenders. You'll see the names that are rather large, like Wells Fargo Bank, US Bank, but you're also going to see names like Bremer, a strong player in the market, TCF, and some credit unions, Flagstar. You can see the percentage, and obviously it's dominated by Wells Fargo and US Bank, who combined have about half the market. Now, one of the things that we used to always look at, and we do look at as it relates to lending in HMDA, is the approval decline ratio. Now, this stat shows that overall there is an 85% approval rate for that by these particular lenders. And you can see that's about 15% decline rate. Each institution is slightly different. And so an institution like Alerus with 98.9% approval rate and only 1% decline rate represents a significant outlier. On the other end of the spectrum, US Bank at 73.4% approval rate and 26.6% represents also an outlier with obviously a greater number of declines. Historically, that's kind of where we were positioned. We didn't have a lot more, but things have definitely changed. Let's talk about new HMDA. Now, new HMDA is 2018 and going forward. So now we're in 2020. We're soon to be able to review 2019 data, but 2018 provides its own meaningful insights because it has factors that we never had access to: debt-to-income ratio, loan-to-value ratio, interest rate, the stated minority population percentage, as opposed to having to go through all the machinations to try to determine that, the property value, the loan term, total points and fees, and an abundance of information. Now, TD, I know as an analyst, you like to have information. Am I right?
Oh yeah. It helps so much when you're trying to figure out exactly how to make a model that best predicts whether or not someone gets approved or denied.
Yeah.
And as we're going through stuff with our different clients, that's a lot of what we focus on. We try to find out exactly what is going on in their models and where we could possibly improve them to give them better results and better accuracy for their clients.
Yeah, I think you would say that just because you have a 98% approval rate or a 75% approval rate doesn't necessarily mean it correlates to risk. And so
That's true.
With these factors, we have so much more insights than we've ever had. But not only does that mean we have so much more insight, that means everyone has powerful insights. And that's really what we're going to talk about here today. So analysis becomes powerful. We have the ability to filter in order to eliminate the argument. You always want to try to eliminate arguments as it relates to fair lending. So for example, we could filter down to single-family properties that were for purchase, those CFLs. But then we can also look at closed end, eliminating the open end. We can eliminate the business purpose loans. We can eliminate the non-owner occupied. We can look at just loans that were for 360 months, and we can look for loans that are amortizing the debt, not just interest-only payments. Of course, you can further isolate, but eventually you start to pare it down to the point where there's no meaningful analysis possibility, and that's not always good. So that's what we did for this particular analysis that we're about to show you. We isolated down by these factors, and then we took the next step, which is the concept of assigning underwriting factors. Now, TD is a regression analysis wizard. What I wanted to do was to simplify it a bit. And so we just kind of isolated by various group segments the various factors that we had available to us, which happened to be loan to value and debt to income. Now here we're talking about, obviously, if you have a low loan to value and a low debt to income ratio, you would expect that to be a higher qualified borrower. It doesn't necessarily guarantee that that has the lowest risk, but it is an indicator risk. And I think we'd all agree that is important. The other thing that we did is typical that we assigned those census tracts with 50% or higher, and we used rounding, that are considered minority population. We classified those as high minority census tracts. You can get more sophisticated in your analysis, but that's a good starting point. So are we ready to take a look at the numbers?
Shall we?
All right, so now we're looking at the same institutions and we're looking at their baseline approval to decline. We've isolated out to those factors, and you can see that not only did Alerus perform well, it actually performed even better. 99.7 approval rate with a 0.26% decline rate. I don't know how many times that is lower than the average for the entire group, but I know it's a lot lower. As opposed to, let's take a look at Wells Fargo, 93.5%, so significantly higher. And you could see most of the institutions are in a band of between 92 and 96%. Most of them having less than, well, all of them having less than 10% decline rate. All right, so now we've taken a look at the overall. Let's take a look at the next slide, which gets us into the approval to decline as it relates to high minority census tracts. Now, those particular ratios, you can start to see a lot of hundreds in there. And if you go all the way down, you'll start to see the lower percentages. The Wells Fargo Bank at 86.4, US Bank 86.7, and there's one more. Can you see it there? Oh, Associated Bank at 87.1 as it relates to high minority census tracts.
So Ken, what does this 100% approval percentage mean? What is the gist of this? How does this affect a high minority census tract?
So obviously, all things being equal, which we don't have here necessarily, we're taking a look at 100% of loans in high minority census tracts being funded. So everybody who's in a high minority census tract applying for our isolated product by Alerus and by Flagstar was approved, as opposed to low minority census tracts, for example, in Flagstar, having 92% approval ratio. So you're better served in a high minority census tract to get a loan. Now, does that mean that 100% is naturally fantastic? Well, on its face, it sounds great. But oftentimes, if you're on the examination side and you see 100%, you know that that's an outlier. You're going to probably receive greater scrutiny as it relates to other codes, such as withdrawals, or approved not accepted, or closed for incompleteness. The examiner will not generally accept that 100% of loans are being funded. It doesn't make statistical sense. And that's a problem for those institutions. They really have to make sure that their loan review process is sound. On the other end of the spectrum, TD, when you have a higher decline percentage to high minority census tracts, obviously that's going to be a scrutiny. But just because it's a high minority census tract or low minority census tract isn't the full story. Let's take a look at the next slide as it gets into individuals who have been classified or who self-classify as minority. Now, TD, this is a very complex area because identifying minority and non-minority is as much art as it is science. And because of that, institutions need to spend a lot of time reviewing how they classify an individual as minority. Given Minneapolis's population demographics, it makes sense to kind of further isolate it. But that's a little bit too sophisticated for our spotlight today. So what we went and did was to identify carefully through the process who we believe is fully classified as minority or fully not classified as minority. And we broke those into two groups. Everybody else we put into the other category, and we isolated that out. So now we're just focusing on the two. And here again, you start to see that while Associated had a very high minority census tract, when it actually came to minorities, it's significantly different. So back up one slide, let's take a look at the two. And when we take a look at Associated at 87.1 in high minority census tracts and bounce forward to 77.4, now you can see a significant risk factor. Does it mean that there is a problem? No, but does it indicate a risk factor? Absolutely. And that's really what we're talking about when it comes to fair lending, identifying the risk factor and making sure that institutions focus on that appropriately. You can go through this various list and take a look at the institutions. The average is 96.1 for approval ratio. Anytime you start to get a far afield of that, either high or low, you have an issue. That's where you want to be spending. So it's like that sweet spot as it relates to fair lending. Doesn't necessarily guarantee that you don't have any risk, but it does indicate that your risk factors have been reduced. So organizations would be well served to evaluate their performance at least at this level and obviously on a more sophisticated basis, which is what we're going to take a look at next. So interest rates. Now we're focusing on what has been long wanted in HMDA, not just to see approvals and declines. Let's take a look at the actual pricing. When we're talking about interest rates, we're taking a look at how organizations price their funded loans. So these are all category action code 1, but now we're taking a look at the various groups. You could see, for example, that Alaris in minority areas was at 4.5. The average is 4.66 for minorities, compared to the non-minorities at 4.60. So not a significant gap difference between the two. You could see some differences. Bremer Bank at 5.09 obviously is the greater outlier for rate, as opposed to 4.74, also an outlier. So both interest rates for Bremer are higher. That might mean that Bremer has different standards as it relates to loans within its own organization. Doesn't necessarily indicate a problem. It just, again, indicates a risk factor meriting additional review. Can you see who's at the lowest then there on this particular minority, non-minority?
Yeah, it looks like JP Morgan Chase Bank has the minority rating of 4.39.
4.39 certainly represents a significantly lower rate for that particular group. And when you take a look at the HMCTs, you can see that high minority census tracts are actually fairly higher, or right at the average, but definitely higher. So that tells you that JP Morgan is likely implementing some type of program. Good for them. That might be exactly what they wanted to do for CRA or for fair lending purposes, but of course, it's worth noting. So every organization has to take a look at its rate relative to these factors. This is just a starting point because I think our next slide shows us that greater sophistication can be pursued. Let's take a look at that. Now we have the ability to add the powerful underwriting analytics to give additional insights. When we take a look at these scores under HMCTs and LMCTs, as well as the next slide, what we're looking at is the risk score. The risk score for our organizations is something that we generated. All organizations have the ability to identify risk. Most loan production systems or loan origination systems identify risk. Obviously, FICO scores and credit scores by the three bigs have been doing that for over 40 years, I believe. When you take a look at underwriting factors, you have the ability to look deeper into the process. What you have here under the HMCT and the LMCT is a culmination of us taking the factors that were available to us, loan to value and debt to income, assigning a score for each as it related to ranges, and then multiplying it. Those ranges were applied. The higher the score, the greater the risk. Now what we're talking about is relative to risk, does the pricing make sense? And you can see that we've put those side by side. So the highest risk, if you can identify it for me, TD, I think it's Spire. Is that what you see?
I do, 23.86. That's really high.
That's very high. So we're saying that based on our use of applying the underwriting factors, Spire Credit Union had the highest risk. But when you look at its actual rate at 4.55, it's below the overall risk. So Spire itself would be an organization that would say, hey, not only are we not necessarily at the risk level according to this, but we're below based on that risk. Safety and soundness factors being something else, but from a fair lending perspective, you'd have to applaud their efforts. Now, can you see anybody else who's a little bit of an outlier?
I'd say that Chase Bank happens to be an outlier again.
Yeah, 7.75. That's a remarkable score, less than half of the average. And yet their rate at Chase or JP Morgan Chase is about the average. So the risk is very low, but the rate is about the same. Again, a risk indicator doesn't necessarily establish anything, but it does tell you that greater analysis may be warranted. You can look across the spectrum at who's high and who's low relative to risk, and you start to get an appreciation that the two need to correlate. That becomes an important factor as it relates to HMCTs. Our next slide, of course, gets us into a very similar type of analysis, but now we're looking at how individuals self-classified. So we're talking about minority versus non-minority. I don't know if you could see, but it's a little more homogeneous, generally speaking, but there is some interesting elements to talk about. You see anything there you want to throw out?
Chase Bank, again, has a non-minority of 8.62. That raises a few eyebrows.
Yeah, because take a look at their pricing. Their pricing for non-minorities is relatively low, but actually the risk factors for JP Morgan Chase Bank for minorities is a little bit higher, but the pricing is significantly lower. There are probably very logical explanations for any one of these institutions. And our point here on Compliance Spotlight is to look at the data, reflect it, and then look for greater insights. When you look at any organization, you're trying to evaluate from a fair lending perspective, is everything where it needs to be? Is it copacetic? A word that old examiners always used when I used to be in that side of the business. All right, we've just touched the tip of the analytics iceberg. We know that there are new powerful insights. Those insights, of course, are for every organization to balance against their risk. But one of the things that we know that can be done is a more powerful regression type analytics. TD, you've done that. Tell us a little bit about how this information applies to every organization.
Yeah, here at AdviseX, we use that new HMDA data to provide better analysis for our clients. We take it and provide models with greater accuracy, and we're able to manage the risk that they are presenting with their models to a greater degree.
Yeah, I think you're going to find that that type of approach is going to expand, especially with 2019 coming out with even more information. Pretty exciting times. I thank everyone for being here. I'm Ken Agel for RiskWatch Plus.
And I'm TD Wilcox.
We'll see you next week.